Welcome to the Daily Update, where I'll go over the action in the market for Thursday, December 21st, and then we'll see how things look for Friday, December 22nd. We saw a nice little rebound. We didn't regain everything that was lost on Wednesday, but we did see this buy the dip mentality as things still remain positive overall. We're still looking extreme positive with a lot of our charts, and I'll go through those. But the fact that we did bounce up after having a pretty solid down day on Wednesday is an encouraging sign. As the week is playing out, we're seeing volume really start to drop off. So we're getting more and more into holiday mode, which means that those big players that are still involved, they can have kind of an influence on what happens. But we're still maintaining more of a positive stance, although an extreme positive stance. Let's go back and talk about what happened. We did have a higher open. The futures ended up being fairly positive. We were up from about 0.4% to over up 0.5% before the market even opened. And that produced a higher open with prices climbing above the daily pivot at 47.25. Then we chopped back down below the daily pivot. I was watching the intraday bars, and there's some real tug of war going on. That's what you see in a more low volume environment where you have the buyers who are convinced we're going higher, the sellers convinced we're going lower. And so we see these wide bars and really wide swings just within one bar. As the day went on, prices fell back to about the 47.10 level, which was about where we had yesterday's S3 level. And that's where we ended up finding some support. We were able to climb back above the daily pivot, row close, that should be two close, at the intraday high. So that was positive. We saw later day buying and we closed pretty much at the high for the day. That's always a good sign. We were up 1.03% on below average volume. That is really dropping off. We are positive. It's still this idea that possibly we're shifting from a more hawkish Fed to a more dovish Fed. We're also coming into the holiday season, and folks are kind of wrapping things up and focused more on the holidays than they are so much on the stock market. There'll probably continue to be a real drop off in volume, not only in Friday's session, possibly, but next week as well. The week between Christmas and New Year's tends to be pretty slow, but we still watch things anyway. And we're keeping an eye on geopolitical concerns, specifically in the Middle East, Israel, and then things that could be developing in Yemen. What are some comments that we can make? There was some late day buying that led to a broad-based bounce. This is more encouraging. It wasn't the mega caps. It wasn't just some individual stocks that really led things higher. It was more broad-based. After Wednesday's decline was seen as a buy the dip type of an approach. On a short-term basis, we still have our ADX chart showing that our trend is really extreme. The 20-period exponential moving average, the Stochc RSI, Williams percent R, CCI 20, stochastics, and the PMO oscillator. The list is a little bit shorter. We have a few things coming off and a few more things coming back on with the up day. We're still kind of long here with the intermediate term, with the ADX chart, the 50-period moving average study, the standard deviations chart, the Arun indicator, the PMO studies, the chicken money flow, as well as the Sean trend meter, the balance of power, the RSI based on 14 periods. Notice that the RSI based on 9 is not on the list. The bullish percent index for the S&P, as well as the NASDAQ 100, and our new high, new low study for the S&P based on 10 periods. Long term, we're still above the 150 and both the 200 simple and exponential moving averages. We are in this process of shifting that maybe the Fed isn't going to be as hawkish. Maybe they're going to come over and be more dovish, with the idea that the next thing they do may be to cut rates. There, how's that for a slip up? And this possibly may happen as soon as March, but this is going to change as economic reports come out. The dollar was up slightly and interest rates were also up. We came up to 3.89% for the 10-year yield. We're still inverted with the 10 to the 2 and the 10 to the 3 month. And we're back to looking more positive as far as sentiment. We're one tick below that 75 level. We came in at 74, where we had dropped down to 72. We are still positive with our trend. We're above 20. We're even still above 40. We're seeing a little bit of a rollover with our short-term ADX, but we haven't really crossed over yet with the intermediate term. Our bias is now positive with the update, and our momentum continues to be positive. We did get a lot of reports that came out. We had the leading economic index. It was down 0.5%, a little bit more than the down 0.4% that they thought was going to happen. Last time it was down a full percent. Weekly jobless claims came in weaker than expected at 205,000. They had expected 218,000. Continuing claims came in at 1.865 million, and I have charts to show you. The third estimate for real GDP, that means that you take inflation into account. They actually lowered it. They thought it was going to come in at 5.2%. It's still pretty healthy, but it came in at 4.9%. Last time it was at 5.2%. The deflator came down a little bit, and that's seen as more market friendly. They had expected 3.6%, which is what we had last time. Now it came in at 3.3%. The Philadelphia Fed Index, this dropped more than they thought. It was at a minus 10.5. Last time it was at a minus 5.9. They had expected it to come in at minus 3. So here are some charts. Here are weekly jobless claims where we did tick up just a little bit when we look at the week over week reading, but we're declining when we look at the moving average. Continuing claims are also continuing to go up, and this is suggesting that maybe there's a little bit of weakness in the employment situation, but not really anything all that crazy, at least to this point. So when we look at this all together, the red line are the initial claims, and they're going down. The continuing claims are kind of chopping more or less sideways, and we did get the unemployment rate down at 3.7% with the last reading that we received. Here is the GDP and the deflator, where the blue line is the GDP, and it's still going up. 4.9 is still pretty healthy when you measure the economy, and the deflator is also coming back up a little bit above 0. Then when we look at it on a year-over-year basis, we are showing personal consumption continuing to go up. We are still negative when we look at imports and exports. And then the real GDP year over year, it's continuing to go up. And that this is showing that the big economy is really showing some growth and not too much growth. Here we have the Philadelphia Fed Manufacturing Index, where it was down greater than expected, and that's showing contraction. And then we had the LEI, and this is a little bit different chart than what I usually show, where we have the gray line, that's GDP, where we're coming in with real GDP. The blue line is LEI. And we came down to some really low level readings. And these readings that we had quite often will signal that we're going to go into a recession. We really haven't bounced up off of that yet. So this is one of the charts. If you wanted to make the case that we might head into a recession, this is one that you would use to justify that. But there's a lot of other charts that you can look at to say, no, we're still hanging together, especially when it comes to employment, that weakness is at least not starting to develop yet. Here's our intraday chart where we had a higher open above the daily pivot, and we really chopped around here. You can see a lot of movement, and we ended up dropping down below the daily pivot. We came back down a little bit below S3 from Wednesday's session, and then this is where we were able to get some support, and then we came back up to the daily pivot. We never made it up to R1. With the big move that we saw, the pivot points were quite far apart, but we ended up closing at the high for the session, and that's usually a positive thing. Here's the intraday chart where we saw some strength going into the pre-market session, and then we saw some weakness come in after that, but then some late day strength coming back in. We are down a little bit in the initial overnight session, and we're seeing where value is outperforming growth. The red line is above the blue line. That's a little bit of a concern, but we were up a little bit with our S&P growth to value ratio. Nothing all that great, but growth did outperform on an intraday basis. So when we look at our end of day charts, growth was up more than value for the large caps as well as the mid caps, and it was underperforming just a little bit for the small caps, but all areas were positive. The middle area, again, that is the ETF that we mainly look at for the large, mid caps and small caps. We're not showing that much of an improvement here with our growth to value ratio for the S&P. We're going up, but we want to see this going up. And I've been harping on this in pretty much every video. This is one of the warning signs that we're really keying in on. As the index has been going up, this ratio has been going down. We want to see them both going up together. We are seeing some improvement when we look at discretionary versus staples. We look at the equal weight ratio down below. This is continuing to break out and showing some improvement. Earlier in the year, discretionary was one of the stronger areas. Since the summer, it's been one of the weaker areas, but now it could be starting to make a bit of a comeback, and that is a good thing. When we look at mid-cap growth to value, this is still continuing to go up. We're not seeing strength in the small caps, but we are seeing some strength here relative in the mid caps, and that's a good sign. Looking at our trend, we're rolling over a little bit with the ADX, but we're still above the moving average. The green line is still on top, but it's now finally dropped down below 40. And we are getting close to the moving average with our short-term ADX, and the green line is also dropping below 40. We're dropping off as far as volume. We're actually continuing to go more under average here. Looking at sentiment, where we're still in a positive time, pretty much from Christmas going into the end of the year, maybe next week, this is when we could possibly see a bounce up in the VIX. The Ulcer Index is still showing that there's not a lot of fear in the market. We're pretty much sideways here with the VIX on the line chart as well as the bar chart. We're still underneath both moving averages, and the VIX readings are still quite low, showing that there's not much fear. We dropped down just a little bit as far as volatility of the VIX. We're still above the moving average with the bar chart as well as the line chart, but it came down slightly. This is a chart that I usually only show in the deep dive video, but we're starting to spike up here. And again, sometimes this can mark a bottom, or it can also mark a top. So we're not above this dashed line yet. I just wanted to bring this up because we're getting kind of close. It might turn and go back down, or if we start to get extreme, we'll be watching this chart more closely. We are seeing a bit of a pickup with the VIX to move ratio, showing that stocks are more volatile than bonds lately. And I do have the equity put call charts. This time we decreased a little bit on the daily chart. We're still, it's really hard to see. We're ticking up slightly with the 5 period, but overall, we are continuing to decline, which tends to be positive for the market. We ticked up just a little bit with this fear gauge, and we also ticked up with the other fear gauge that we look at. And we did get the latest reading of the American Association of Individual Investors. They're starting to get extreme again here. They tend to follow what's already happened. A week ago, things were positive, and so we're up into this area. It could go higher than this, but this is where we start to look at using this as a contrarian indicator. We are seeing an improvement with the risk on to risk off ratio. It declined on Wednesday, but then it went back up again on Thursday. And when we look at our advanced decline line studies, we did show an improvement with price as well as volume. We're still well above the moving average. So this is still holding up. And we're dropping off in our new highs, mainly because we're kind of chopping around within the last few bars here. It was actually more encouraging when we had the big down day on Wednesday. We didn't see an expansion of the new lows, and then we came back up, so we saw a little bit more new highs. And even though this is going sideways, both with the 5 period and the 10 period, and this is dropping off, it's still looking more positive. We're no longer extreme with our advanced decline ratio. Both the blue line and the red line are above 0 and positive. We did turn back up with accumulation distribution. We were getting kind of far away from this moving average. We're still kind of far away from it, but after declining in Wednesday's session, we turned up in Thursday's session. The Chaikin money flow is also showing some improvement, but giving us kind of an extreme positive reading. We did see an improvement as well with the cumulative NYSE advanced decline line, where it was up, as well as our regular NYSE advanced decline line. We also saw an improvement with our other advanced decline line for the NYSE. Another day or two, and we could actually see a golden cross with this advanced decline line. And we're breaking back out based on price with the advanced decline line. We haven't quite broken out yet based on volume. This is the reverse of what we've been seeing in this chart lately, where volume has been tending to lead price. Right now, price is leading volume. Just a tiny bit of a warning sign there. Looking at our advanced decline line studies, we were up with the NYSE common stock, the S&P, mid caps, and small caps. So across the board. Looking at the daily chart, we're still above this pivot point here. That's providing some support. It's kind of with the R3 level that we hit in Wednesday's session, and we were able to bounce up off of that. So shorter term support continues to hold. On the bottom, we're really dropping off with volume. And then on a 1-day basis, we were extreme negative with the advanced decline ratio after Wednesday. Well, now we're looking extreme positive when we look at Thursday's session. And also the rate of change going back 1 day, we were extreme negative after the down move. Now we're just barely getting extreme positive with the up move. With our moving average study, we're back to looking extreme with the 20, 50, and we're turning back up with the 200 period moving average study. The Williams percent R, which dropped down from being extreme positive, is now back to being extreme positive. The CCI 14 is still not on the list here, but the CCI 20 is still giving us an extreme reading. We're seeing some improvement with the force index, but we're still below the midpoint, and the midpoint has started to turn down slightly. Now we're back to extreme in the short term with our stochastics. We're coming down, but still extreme in the intermediate short term, rolling over a bit, but still extreme in the long short term. And we're back up into the +3 standard deviations on this chart. So that's looking more extreme again. We're also getting back to extreme with our boom indicator study. This is how far away are we from the 20, 50, and 200-day moving averages. We're getting extreme with the 20 and 50. We're still showing some improvement with the 200. Some intermediate term charts. We're declining, but we're still extreme with the balance of power. We're still positive as far as the go, no-go system is for the trend. And we're coming down a little bit with our highest high value, but the midpoint continues to advance. And we're showing some improvement again with the TTM squeeze. It had switched to a darker shade of blue. Now for the this last session, it changed over to a lighter shade of blue, and that's more positive. But we're turning down just a little bit with the ease of movement. However, we're still positive because we're above zero. We're still extreme, even though we turned down a little bit with the Arun indicator. And after dropping below zero with the McClellan oscillator for the S&P, we've now been able to climb back above that. And we're continuing to climb based on price, but we're declining based on volume. So we're seeing a little bit of a divergence here. Sometimes volume will be a leading indicator for us. The top part of this chart and the bottom part of this chart are two completely different indicators, but we're still looking positive with our NYSE summation index based on price and volume. We came down to this triple exponential moving average. That's the red line, and that may be providing some kind of support. We were able to bounce up off of that, and we did that previously as we were going higher. But we're still going down when we look at the Swenlin trading oscillator based on price and volume. However, we're still above zero. We're getting extreme and starting to roll over just a little bit with the PMO. We're rolling over a little bit more based on price and volume. Another day or so, and these could actually cross over negative. These tend to lead the PMO indicator itself. We're going back up a little bit with the PMOs that are rising. We're coming down with the buy signals, but we're still extreme positive with the PMOs that are above zero. And we continue to be neutral with the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR. The slope oscillator is continuing to go back up, but it's in extreme positive territory. The MACD is continuing to come down a little bit. We haven't crossed below the moving average yet. So looking at all of our oscillators, we're extreme with the slope. We're actually crossing below the moving average with the TSI. We're coming down with the MACD, but haven't quite crossed the moving average yet. Rolling over a bit with the PMO and the PPO, where we continue to be positive with our longer-term oscillators, the TRIX and the KST. We're still above all of the plotted moving averages in our moving average tree. We haven't really moved all that much with the bullish percent index. This is still positive, but we're getting an extreme positive reading. We continue to go up with the NYSE bullish percent index. That is positive, and we're coming down just a little bit, but we're getting a really extreme positive reading with the NASDAQ 100 bullish percent index. We came down just a little bit with the Sean trend meter, but we're still extreme positive. The Chaikin oscillator is coming out of this really extreme positive territory, and it's still extreme, but not as extreme as it had been. The money flow was pretty much flat, but it's above 50. That's positive. The ultimate oscillator turned back up slightly and is still positive. The vortex, the green line, actually continues to decline, but it's still positive since it's on top. And we're no longer extreme with the percent B indicator. We did see a bit of an improvement in Thursday's session. The Copic curve continues to be positive. We're starting to get extreme with the 14-period RSI. We're not quite extreme yet with the 9-period. That just has to do with how these are calculated. On balance volume continues to be positive. We're still getting a really high reading with the stocks above their 200-day and 50-day moving averages. We're up into the 90% range. That's usually when we tend to top out. I don't have any Fibonacci or line studies now because we're in no man's land with all of those charts. So looking at the trend, we're still showing kind of a doji candle here with the Heiken Ashi. The Kegi chart, it's positive because it's black, but now it's pointing down. So that's positive in the longer term, but looking more negative in the short term. But the Renko continues to be positive. The 3-line break continues to be negative. So we're turning more negative. So we're seeing kind of a mixed picture with our different charts. We're coming back up a little bit with the 150 and 200-day moving averages, and we're still extreme positive. We're still above this weekly trend line here, looking at the S&P chart going back to the 1987 crash. If we fall, we'll be seeing if this ends up providing some kind of support. The fact that we're still above this is positive, and we're trying to peak our head just a little bit above this with the NASDAQ 100, but we're pretty much right on the trend line. And we're showing some improvement with the equal weight index since we saw more of a broad-based bounce. It's starting to perform about the same as the S&P weighted index, and didn't see much of a change. We were down just a little bit with our ratio between the S&P and the equal weight S&P. And this is where we're seeing a negative divergence. We were back up with the Dow, although we haven't set a new all-time high. We were up with the transports, but we haven't been able to come back even to this previous high here. We did go down just a little bit with utilities, which is giving some support to the S&P. The transports continue to underperform the Dow, and that's one of our other warning signs. The Dow was up, but did not set a new all-time high. We're continuing to be neutral for the diamonds, and we're still maintaining support here with the NASDAQ, and we are looking better, although we didn't set any kind of a high, at least a swing high for this period. We also showed some improvement and holding with support with the NASDAQ 100, but did not set a new all-time high. We continue to be neutral for the QQQs when looking at the Elders Impulse system. We're still positive with the momentum for the NASDAQ 100, but this is rolling over just a little bit. And this is the weekly chart of the QQQs where we're generating a really nice looking chart, but we did not come back and set the all-time high again. The small caps did see a bit of an improvement, but it was another inside day to the upside. They were up over 1.5%, but they're not really breaking out at this point. However, the longer we stay above both of the moving averages, the more likely this will give us a golden cross. And we're still above this resistance level, which now is acting as support when we look at the Russell 2000 small caps. We're coming back up and looking extreme with the RSI. We're showing an improvement here with our longer term trend, and we're still positive with the MACD showing that momentum is positive. We continue to be neutral for the small caps, and we're chopping more or less sideways, but hanging in there with the mid caps and getting close to a golden cross. The mid caps continue to be neutral for the Elders Impulse system. We were up almost 1% with the financial sector, so that's still showing some improvement. The micro caps were up over 2%, about 2.25%, back up into the 114 range. We didn't set a new high yet with the FANG index, but it's still holding up, and we're still looking okay. We didn't set another all-time high here. We're wondering, is this going to end up presenting some kind of problem here? But for right now, we are showing some improvement. The dollar was up slightly. We continue to be in a longer-term uptrend, but in the shorter term, we've been going down with the dollar. We were up slightly with the 10-year yield. We were down based on price for the 10-year ETF. We're still getting a positive result when we compare the 1-month to the 3-month yield. And then updating our growth to value charts here, we're looking a little bit better with the Qs to the S&P. Also a bit of an improvement with discretionary to the S&P, and that's been a little bit brighter light as we've been seeing things improve slightly. But when we look at large cap growth, the large cap value, we're not really seeing much of an improvement there. Our other growth to value ratios, we're pretty much flat with the large caps, showing some improvement with the mid caps, and that's giving us a little bit more strength. We're not really seeing any strength when we compare small cap growth to small cap value. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We've been camped up here now for well over a week. And we're still positive when we look at the broad market of our 5-period moving average of the highs minus the lows. We're still advancing with our new highs minus new lows for the S&P 500. And we're getting extreme again with the 50-period moving average study for the small caps. We're not there with the S&P. We're not there with the mid caps, but we are getting back there with the small caps. The S&P to utilities ratio is starting to go back up, and that could give support to the S&P. We're seeing the 2-year yield continue to decline, which is also giving support to the S&P. And the Staples to S&P 500 ratio continues to decline, which also gives support to the S&P. So what's our outlook for Friday? We're still getting more and more into holiday mode as volume is dropping off. Friday will be the last trading day before Christmas. Then we'll have earnings that are coming out. They're always coming out. We're still overbought, even though we continue to be positive. As for right now, the weakness that we saw on Wednesday was used as a buying opportunity on Thursday. We will get personal income and spending. That's the other big inflation report that we'll be receiving with PCE prices. Durable goods also will be coming out, as well as new home sales and consumer sentiment. So we've got a pretty heavy docket of economic reports coming out. We're also keeping an eye on geopolitical events, specifically what's happening more in the Middle East, and wondering if that's going to expand to a more regional conflict. Here's the economic calendar. When I do the video for next week, I won't be doing the video for Monday because that's Christmas. So it'll actually be done for Tuesday's session. I'll have the new calendar here. Looking at seasonality, we're neutral to negative with the Dow and S&P, where we're flat out positive with the NASDAQ. We are coming into the last day of the week after options expiration, which tends to be positive. We're wondering if the January effect is still going to continue. We are seeing a little bit of a bounce here when we look at a pre-election year for the S&P. We will be on the 16th trading day of the month. Also, Carson is suggesting that we have some positive seasonality, and Friday tends to be the second most positive day, at least in 2023. We're also seeing positive seasonality during a pre-election year. This is also showing positive seasonality, other positive seasonality. And then near the end of the year, we might see some weakness according to this chart. But right now, we tend to be in a period of positive seasonality. Also, Carson is showing that we have positive seasonality. And this, since we're getting later in December with the equity clock chart, is showing positive seasonality for right now. We're also seeing positive seasonality for the NASDAQ as well as the S&P. And then we're wondering if 1982 is going to be kind of closely related to what we are seeing right now. We kind of are showing some similarities between the two. If that's what ends up happening, then 2024 could end up being a pretty solid year. So our scenarios, we're not going with the down one, even though we continue to be overbought, but we are still positive with our charts. And now folks are using this idea of possibly buying the dip. So we're going more with the up scenario, at least for now. But be aware, we are overbought. We are going into holiday mode. And so there may be not the price action that you might always want to see. We're still concerned about our trend because we're extreme both in the short and intermediate term with our ADX charts. The warning signs, growth is still not really participating. That's another warning sign, as are the transports. They're not breaking out the way the Dow had been breaking out. The equity put call ratio is now going back up. Okay, so that's a bit of a warning sign. It just ticked up a little bit. But if you look at the bigger picture, it's still going down. We're still dealing with downtrends when we look at the Russell, the small caps, and the mid caps. But that could be improving the longer we stay above both of those moving averages. We have a pretty long list of positive signs, with our daily special K chart being positive, our longer-term equity put call ratio, the risk-on posture, the oscillators that we look at, even though they're getting extreme, they're still positive for right now. The parabolic SAR and the vortex continue to be positive. The bullish percent index, it's positive, but it's extreme positive. The Kopit curve is positive. The Zahorchak method has shown some improvement. It's now neutral where it had been negative. And we're not really seeing much when it comes to small cap growth versus value, but we're seeing some improvement when we look at the mid caps. The financial sector is still looking better, and the 50-period new high, new low study continues to be positive. So our conclusion, we're still overbought and we're wondering, is this buy the dip mentality going to continue? In the short term, we're wondering if that's what's going to happen. Even though we continue to be positive and overbought, we're looking more overbought still in the intermediate term. We're slightly overbought in the long term because we're above extreme readings with those longer term moving averages. Thank you. I hope you found this helpful. I hope you have a really good day, and I will be preparing the videos over the weekend. It might be a little different schedule with family obligations and holidays and so forth, but I'll get those posted just as soon as I can.